Something is sitting on this market tonight that I have not seen in a long time. There is a hard deadline. An 8 p.m. deadline set by the President of the United States involving the Strait of Hormuz, one of the most strategically sensitive choke points on the planet. And right now, precious metals markets are pricing in the possibility that tonight changes everything. Gold is sitting at $4,640. Silver is at $72.44. And if you are holding either of those metals right now, what happens in the next few hours matters to you personally. Stay with me because before this video is done, I am going to show you the one number in the COMEX data that tells me the gap risk tonight is real, and it is not the number most people are talking about. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have watched geopolitical events hit these markets in real time. I have seen the gap opens, the forced liquidations, the panicked repositioning when a deadline becomes a development. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here at Currency Insider. Everything I show you today comes from publicly available sources. I will name everyone as we go so you know exactly where it is coming from. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are building here week by week is a framework for reading these markets, not just reacting to them. Today we are covering three specific things. First, what the COMEX registered inventory data actually tells us about physical buffer risk tonight. Second, how the paper market is positioned right now and what that means for a gap open. Third, I am going to show you the 3 lanes framework for this specific setup so you know exactly what to watch and when. Last week I told you to watch the DXY, specifically whether it could hold the 101 level as dollar weakness continued to interact with metals prices. I said if it broke below 100, the upward pressure on gold would likely accelerate. As of this recording, the DXY is sitting at 99.91. That level cracked, and gold has moved. I am putting that on record because that is how this channel works. I get it right, I tell you. I get it wrong. I tell you that too. Now let us talk about what is actually happening tonight. Before we get into the data, I want you to drop something in the comments right now. Are you holding physical silver going into this 8 p.m. window? Or did you already take some profits into this move? The comments here become a real-time sentiment read for this community, and I read every single one. Here is what the price action is telling us right now. Gold at $4,640 is not a random number. 3 weeks ago, this level would have seemed aggressive. Today it is a holding pattern while the market waits for a binary outcome. Silver at $72.44 is following gold, but with its own structural story layered on top. And that structural story is where this gets genuinely interesting. The trigger for today's video is that 8 p.m. ET deadline. President Trump has set a hard window involving the Strait of Hormuz, a waterway that handles roughly 20% of the world's oil supply. Now here is what the market is actually doing with that information. It is not panicking, it is positioning. And there is a difference. Panic selling is visible. Prices collapse, spreads widen, volume spikes chaotically. Positioning is quieter. You see it in open interest data, you see it in COMEX inventory levels, you see it in the way the DXY is behaving, and right now all 3 of those things are pointing in the same direction. Let me start with the number that stopped me cold when I looked at the COMEX data. The registered silver inventory, that is the metal that is actually available and ready for delivery, sits at 103 million ounces. Now on the surface, 103 million ounces sounds like a lot. But here is how to think about that correctly. Open interest in silver futures currently sits at 108,000 contracts. Each COMEX contract represents 5,000 ounces of silver. Do that math, and you get 540 million ounces of paper silver obligation sitting against 103 million ounces of registered physical metal. Think about what that actually means. Imagine a hotel with 540 guests who all have confirmed bookings, but only 103 rooms that are actually ready for check-in tonight. Most of the time, this works because most guests never actually show up at the same time. They cancel, they roll forward, they leave before checkout. But if something happens that makes everyone want their room tonight, at the same time, you have a problem. That is the COMEX setup right now. And the reason tonight matters specifically is that a geopolitical shock of sufficient size is exactly the kind of event that makes everyone want their room at the same time. When I pulled the CME warehouse data this week, here is the additional detail that matters. The ratio of eligible to registered metal, eligible being metal that is stored in COMEX-approved vaults but not yet made available for delivery, has not provided the usual buffer it historically does in supply stress events. The system has less shock absorption than it did 6 months ago. That is the physical picture. Now the paper market. Here is how futures open interest actually works, because there is a common misunderstanding about what a high open interest number means for price. Open interest is not a countdown to physical delivery. It is a count of every open position in the market, longs and shorts, and it can stay elevated for extended periods with no delivery event whatsoever. Most futures traders have no intention of ever touching physical metal. They are managing financial exposure, not acquiring silver bars. So when someone tells you that 108,000 contracts against limited registered inventory means delivery squeeze is imminent, that needs context. Think of it like counting every person in a stadium and assuming they all want a hot dog at the final whistle. A lot of them will leave before then. A lot will not even be hungry. The number alone does not tell you what happens next. What the number does tell you is this. The bigger the open interest, the larger the potential move when something forces rapid repositioning. If tonight's deadline triggers a significant market response, either direction, the unwinding of those 108,000 contracts will amplify the move. That is what gap risk actually means. It is not a forecast that the market gaps higher. It is a recognition that the conditions for a large move in either direction exist right now. And I want to be honest with you about that second direction. If tonight produces a diplomatic breakthrough, if the deadline passes and tensions de-escalate, the article I have been looking at this week correctly identifies the other scenario: speculative war longs. Positions built specifically on the expectation of escalation liquidate hard and fast. Gold could drop $100. Silver could give back several dollars. Both of those scenarios are live right now. That is not hedging. That is reality. There is one more layer to tonight that I want to make sure we cover correctly, and it connects the geopolitical event to something structural in the dollar. The DXY at 99.91 is doing something interesting. In previous periods of geopolitical stress, and I have watched quite a few of them from inside these markets, the dollar typically functions as a flight-to-safety asset alongside gold. You would see gold rise and the dollar rise together because both were being bought as safe havens. What we are seeing now is different. Gold is rising while the dollar is weakening. The U.S. 10-year yield is sitting at 4.35%. And rather than acting as a ceiling for gold, which is how higher yields have historically interacted with precious metals, it is being treated by the market as a symptom of fiscal pressure rather than a signal of dollar strength. The Congressional Budget Office has been flagging for several quarters now that the U.S. deficit trajectory is structurally difficult. That context is sitting in the background of every gold trade right now. I am not saying the dollar collapses next Tuesday. What I am saying is that the relationship between yields, the dollar, and gold has shifted, and that shift makes gold's behavior in a geopolitical stress event more powerful than it might have been 3 years ago. For viewers in the UK watching this, the LBMA spot price has been moving in lockstep with COMEX tonight, and the sterling-denominated gold price has its own additional driver. Pound weakness against a broadly weaker dollar environment has meant British holders of gold have seen amplified gains in local currency terms. That is worth understanding if you are holding gold in a SIPP rather than a dollar-denominated account. And if you know someone in your life who has been watching their metals stack this week trying to make sense of these moves, share this video with them right now. That is the whole point of this channel. Now let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate noise from what actually matters. Lane 1, the paper market. COMEX open interest at 108,000 silver contracts against a DXY that is broken below 100 creates an asymmetric setup. The CFTC commitment of traders data, when I pulled it this week, shows positioning that leans net long in silver. That means if the market moves against those longs, a de-escalation scenario, the unwind will be fast. Lane 2, the physical market. The registered COMEX inventory at 103 million ounces, against a demand backdrop that includes both safe haven buying and ongoing industrial consumption from the solar and electronics sectors, has less cushion than the market typically relies on. The Silver Institute has been documenting a multi-year structural deficit in the silver market, and that backdrop does not go away because of a single geopolitical event. It actually makes the geopolitical layer more significant. Lane 3. The macro. The dollar at 99.91, with yields acting as a fear barometer rather than a deterrent for metals, creates an environment where gold and silver are being treated as genuine monetary alternatives rather than just commodities. That is a different kind of bid. In 15 years watching currency and commodity markets, the times I have seen all three lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. When the paper lane is carrying this much open interest while the physical lane has limited buffer and the macro lane is removing the dollar safety valve, the historical pattern has been that the volatility, when it comes, is larger than most people expect in either direction. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching tonight and into tomorrow. The 8 p.m. ET window. Specifically, I am watching how the Asian futures session opens after the deadline passes, because that is the first liquid market that will price in whatever happens tonight. The CME Globex session resumes at 6 p.m. ET. If the deadline passes without escalation, watch the first 30 minutes of that session for how aggressively the speculative longs unwind. If it passes with escalation, or with ambiguity, which in some ways is more dangerous than clarity, watch whether gold gaps above 4,700 and whether silver can hold $72 on any pullback. I will be back on this channel as soon as the picture is clearer. This is my one call for the week. John, FX Insider. On record. No edits, no excuses. That is the only way this works. Now, here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture. Escalation tonight triggers a safe haven surge. Asian markets open with a gap. Gold tests 4,800. Silver tests $80. COMEX open interest begins to unwind in a controlled way as longs take profit into strength, and the physical premium that has been building actually attracts some selling from holders willing to monetize. That is the optimistic picture for metal holders. Here is what needs to happen for the cautious picture. The deadline passes with a diplomatic resolution, or a statement that reduces immediate military risk. The speculative longs that built into this event have no reason to hold. They exit fast. Gold drops $100. Silver drops $3 to $5. And in that environment, any new positions entered in the last 48 hours feel uncomfortable very quickly. Both of those are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions, before the two questions. If you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach the people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you holding your current silver position into the 8 p.m. window, or have you already adjusted your exposure? Second, given what we covered today about the COMEX registered inventory buffer, does that number change how you personally think about physical versus paper exposure in your portfolio? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe, because next week we are coming back to exactly what happened tonight. The call is on record, the window will have passed, and I will show you what the data looked like in the aftermath. That is a breakdown worth having, and if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market, protect your currency.